Okay, here we're going to be looking at the sophisticated equity method here for intercompany transactions. And for example, we're going to just have some unrealized profit, or it could be a loss here for the current period, and that's going to be a profit and some beginning inventory. So the best way to make this comparison or look at the sophisticated method and how it works here is to make a comparison here to the simple equity method. So for the simple equity method, you have our corporation S, or the subsidiary. It has some sales, it has some cost of goods sold, and expenses, and then the net amount in this case would have been $150,000 worth of internally generated income, and in this case the parent is going to get 80% of that since they get an 80% ownership. So they would record here a subsidiary income of $120,000, and this is what they would be eliminating here between this intercompany profit here based on this $120,000, and that was off the net amount here of the sales, or 80% of it. And then just going down and looking at our income distribution here for the simple equity method, for the subsidiary, the $150,000 internally generated, and then it was adjusted here for this profit here in the beginning inventory. It was adjusted down to $134,000, so they get 20% of that, or $26,800. Now moving over here to the parent, they would have an internally generated income of $200,000 in this case, and then they would get 80% here of the corporation S's adjusted income. That was adjusted income here for $134,000, so they get $170,200. Total amount here is $307,200. Now these amounts here were based off their internally generated income here for both the parent and the subsidiary, and there's adjustments that were made. Now for the sophisticated equity method here, Corporation P, the parent, has to prepare a subsidiary income distribution schedule first before it can record its share of the subsidiary income. And instead of recording this $120,000, they're going to record the $107,200 here. So let's go down and look at how they would do it here. So they get the internally generated net income of $150,000, and then this adjustment here was for $16,000 to reduce it because of the profit in the beginning inventory here. And then the controlling share here, they would get 80% of that. So we take 80% here of the $134,000, and we get $107,200. Now going over here to our trial balances here. Now for the subsidiary income, the parent for the sophisticated method would record $107,200 here instead of the $120,000, and that's the amount that they would be eliminating here for the subsidiaries, the income here between the parent and the subsidiary. So you can see the difference here with the sophisticated method. We have to first determine the parent's amount here of the subsidiary's income based on our adjustments here that we had to make here for this beginning inventory, and that is the amount that we're going to be eliminating here for using the sophisticated method here to eliminate our intercompany profit versus the $120,000 here that was based off here the sales and the expenses here. Okay, now for our adjustments and our eliminations. But before we move on here, I want to make a point here. For the sophisticated equity method, we calculated here a controlling interest share of the subsidiary's income of $107,200, and that compares with the simple equity method here, where for the parent here, we just took 80% here of the adjusted income of $134,000 for $107,200. And now for our other adjustment that we have to make here, and that's the investment in the subsidiary here by the parent. And for our simple equity method, we had an adjustment or an investment here of $392,000. Now for the sophisticated equity method, what we do is we take the beginning of the year balance plus the sophisticated equity income that we calculated here. So the beginning was $272,000 plus $107,200 for the sophisticated income here gives us $378,000. So you can see a difference here. Simple equity $392,000 versus the sophisticated equity here at $378,000. And then the only elimination we had to make here was the subsidiary's income here. And in this case, we would be debiting here to subsidiary income for $107,200 versus the $120,000, and then our credit here would be the investment here in the subsidiary for $107,200 versus the $120,000 that we'd be using for the simple equity method. Okay, in comparing the sophisticated equity method with the simple equity method, the only changes that we'd make here would be how we calculate the subsidiary's income and also the investment here in the subsidiary by the parent. And then we would be eliminating the income between the subsidiary and the parent based on how we calculate here the subsidiary income based on this sophisticated method. Otherwise, all the other eliminations and adjustments would be the same between the simple equity method and the sophisticated equity method. Okay, now continuing on with our sophisticated equity method here, and our example here, we're going to have some unrealized profit for both the current and prior periods, and we're going to have to first prepare the subs income distribution schedule here. So we take the internally generated income here of $120,000, and then we add, in this case, a realized profit for the beginning inventory, subtract out unrealized profit for the ending inventory, and we come up with an adjusted net income here of $124,000. So with the sophisticated method, this is where we determine the parent share. So we take 80% times the adjusted income here for the subsidiary. That's the parent share here, and we get a controlling interest here of $99,200, the parent share. So going up to our worksheet here, for our recording our subsidiary income, we would use $99,200 here for the sophisticated method. And comparing that to the simple equity method, all we would have done with the simple here, we would take our sales against our cost of goods sold and expenses, and then we came up here with the internally generated income here for the subsidiary of $120,000, and then the parent would have just got 80% of that with the simple equity method, where we wouldn't have had the adjustments in. So now for our eliminations here for the subsidiary's income. So we would go over here when we'd debit here to subsidiary income for $99,200, not the $96,000 that would be used for the simple equity method. And then we would go up here for the investment in the subsidiary or corporation as we'd credit that here for $99,200. And that would be the eliminating this subsidiary's income, or the income between the parent and the subsidiary. Okay, now for our remaining adjustments and eliminations using the sophisticated equity method here. First, for the Corp P, the parent's investment, and Corp S, the subsidiary, we take the original balance here, and then we add in both the sophisticated equity income here for the first year and the second year. So we come up with $478,400. And then our next adjustment here would be for Corporation P, the parent's retained earnings at the beginning of the second year. So we take the simple equity balance and subtract out 80% here of the subs beginning inventory for an amount here of $807,200. And then we have to go here and we have to remove the profit from the subs beginning retained earnings here and the parent's beginning inventory account here. So we go to the subs retained earnings here and we debit that for $16,000, and then we'd go over here and we'd credit cost of goods sold here for $16,000. And then the only other adjustment here has to be eliminating the investment here of the subsidiary. So we would take here the corporation subsidiaries stock here and debit that for $160,000, and then we would also debit the retained earnings here for $219,000. Now that's based on 80% adjustments here of the beginning balance of $274,000, and then adding our balances together here, our balancing entry here would go to credit the investment in the subsidiary corporation for $379,200. So just going over our sheet here, our worksheet here, our investment in the subsidiary was we changed that from $488,000 for the simple equity method here to the investment with the sophisticated equity amount here, $478,200, and then our retained earnings here had to be adjusted for the parent corporation from $820,000 to $807,200.